Hello, beautiful soul, and welcome to Inspire Greatness, the space where growth takes center stage. I am your host, Demi, and I am beyond thrilled to have you join me on this journey. Whether you're a returning listener or it's your first time here, I want you to know that this is more than just a show or a membership. It's a community, a sanctuary for growth, and a place where we dive deep into the essence of what makes us truly human. Welcome, Nicole, to our episode. Today, I'm very excited because we are getting into investments, especially how to build a six-figure portfolio, which you have done successfully. And now we get to share a lot of knowledge on how to build that with the members. And I'm very curious to learn how you did that. So, first of all, welcome to the podcast. It's good to have you here.
Thank you.
I would go in first in letting you introduce yourself and also your background on how were you able to build a successful six-figure portfolio with investments.
Yeah, thanks for having me back. So my journey started probably about 6 years ago when I talked about this on an earlier episode, but just everything was not going my way. And I decided things needed to change and I'm going to just completely transform my financial situation. And so I started investing, and kind of like at the beginning of my journey, I really just wanted to know what is it that wealthy people invest in. And there were two things: there was real estate and the stock market. And so the next question I had was, which one is the easiest to break into? And it was the stock market. And which one required the least amount of money to put up? And that was also the stock market. So I was like, okay, I'm going to learn everything about this I can. I'm already taking advantage of my employer's investment accounts, which were investing in index funds. So I continued to do that and maxing everything out as much as I could. At the same time, tracking my expenses, and I just really took my education further. So I did a lot of self education through online research. I got my master's in finance degree from Georgetown University, top 2 finance program, and it prepares you to take the Chartered Financial Advisor designation, which is the highest financial advising certification out there. So, a lot of really solid financial knowledge that I gained through that program, and honestly, probably the best investment I've ever made in my life was through that education. And so, did that. Got a certified financial coaching certification, and just also attended some different um, events around finance where I heard from a lot of successful financial advisors, traders, and hedge fund managers. So I really taken a very well-rounded approach to my education and learning, and then really applied everything I learned to my own situation, to really get to where I am today and having a six-figure investment portfolio that is completely tax-free once I reach retirement. So yeah,
Wow.
in a nutshell.
Well, yeah. I think first of all, congratulations, because that's an achievement, and it's so good to hear that it is born out of knowledge.
Mm.
Like this whole thing didn't grow just because you dreamt about it. It's literally because you've did all the work. Like you learned about it, you went to events, you listened to others. It's what we're doing here. That's why you're here to share your wisdom with everyone else, because it's learning from everywhere and everyone, and also their mistakes and their successful takes they did.
Yeah.
So Yeah, I'm very excited to now dive into how, in like as much detail as we can go, break it down in like easy steps on how you were able to do that and how can others build a successful portfolio for themselves.
Yeah.
And I would start with the question, could you explain to our listeners what is an index fund and why they are often recommended for long-term investing?
Yeah. Yeah, I love index funds. So where do I start? So what an index fund is, it's basically a package of stocks all put together and sold as one.
Mhm.
So I'll use an analogy, like you could go to the grocery store and, buy a bunch of different vegetables to make a salad, right? You could
Mhm.
buy each one individually, some lettuce, tomato, pepper, onion, or you could go and buy a pre-packaged salad that already has all of those individual items already packaged. So that's basically what an index fund is. It's like a salad of stocks, something like that.
I love it.
Yeah. so so for those that are completely new, hopefully that paints a picture for you. And so the cool thing is that instead of having to pick and choose and try to find which stock is going to do well, you can invest in a bunch at like a much lower price, and you have a little bit of all of them.
Yes.
And there's a couple benefits to them. So first off, risk is a big part of it. Individual stocks have a lot of individual business risk. So if there are like if the company goes through layoffs, if they get a new CEO, if they miss quarterly revenues, all of that negatively impacts that specific company and cause people to want to sell because it's not doing as well as they project it would, which would then cause the stock price to go down.
Mm.
And so that's a lot of like individual business risk. And after a certain point, after a certain number of stocks that you invest in, usually more than 50, that business risk is completely eliminated
Mm.
through that index fund. And so that's one of the really cool features of index funds. Another is that it is self cleansing. So if that company, say, let's talk about Tesla for a bit because their stock price recently declined. So like an index fund could have a little bit of Tesla, have some Microsoft, Amazon, and they're all weighted differently. So whichever company is, we'll just say the largest, which is market cap for those technical here, but whichever is the largest will have the highest weight, the largest amount of weight in that index fund.
Mm-hmm.
Now, if that company um, goes down, like let's say Tesla's part of that fund, and now since their stock price declined, their weight in that fund is actually going to decline and be replaced with another stock, or the other weights are just going to be rearranged to make up for that.
Mm-hmm.
And so it eliminates that individual business risk, and then that can really help with just the performance of the overall fund. So that's a really, I guess, amazing benefit of index funds, is that there's a lot of diversification and risk management already provided with it.
Yes.
Now, if we're dealing with stock index funds, because you can also have like an index funds of bonds or commodities or anything else, that's packaged together. Um, there's also market risk. So things like if there's a war, if there's something political, COVID, all of those things, when there's fear, that affects the market as a whole, right?
Mm-hmm.
And so, like if you're investing in a US index fund of stocks and COVID happens, it's going to affect all those companies. So it will affect that fund. And so to to offset that type of risk would either be through investing in other assets and other different funds that move differently, or by having a long-term investing horizon where you can um, kind of take a step back through those downturns and be okay with it and just ride them out, because over the long term, like stock index funds, they've performed about anywhere between like, I would just say on average around 10% per year, which is a very solid, consistent return that has outpaced inflation.
Mm-hmm.
And that's really where wealth is built.
Amazing.
I threw a lot at you. Hopefully that
I love it.
makes sense.
Yes, I wanna quickly just to give our listeners, because you mentioned long term, can we quickly clear up what is short term, middle, long term
Yeah.
in years, months, just to
Yeah.
give them,
Yeah.
um,
A rule of thumb is like if you need the money within 5 years, I personally wouldn't invest that. Full disclaimer, I'm not a financial advisor, so everything I'm
yes,
saying is education. But what I would do is like anything that short term you need in 1 to 5 years, I would put that in something safe. Like right now, a great thing to take advantage of is a high yield savings
yeah,
account because it's risk free and it's paying a very high amount of interest compared to what it usually does. So
yeah,
I would leave that there. Um, and then like for long-term stuff, like I'd really like when it comes to stocks to be on the safe side, making sure that you have at least 10 years
yeah,
until you need the money
yeah,
because there have been historical periods where the stock market had gone down and you haven't recouped your money until like 10
yeah,
years later, which there's ways to combat that too. And if you're investing through those down periods, that actually provides an amazing opportunity for growth. So
yeah.
I would say like long term, at least 10 years, short term, under 5, kind of midterm, 5 to 10.
Mm-hmm. Okay, good. Yeah, I was just, I think that's important for them to understand what is actually long term.
Yeah.
Um, and would you also, when we say long term for retirement, would you also say that is a good approach for your retirement, as this is probably long term if you have more than 10 years to go? Or would you say that should be or would be planned for goals that you have in like 10, 15 years,
Hmm. Yeah. I think it could be both.
right?
Yeah.
Okay.
It can be both. And it all depends on what your goals are. And also like with stock index funds, um, can you handle seeing the market down and being okay with your money in it? Or are you going to sell after it's
Because
down and pull out, which is going to put you in a worse situation? So it's being able to handle that and kind of understanding the risk. But I think when you really, really understand it and you can look back and see how different funds have performed over time through wars, through panics, you start to understand how it works and
Mhm.
can be okay with it.
Yeah,
I think when you don't understand something, that's when there's a lot of fear. When
yeah,
you understand it, that's when you can kind of take a step back, like when in doubt, zoom out and reassess and then make a strategic decision.
yes. Okay, good. So we now have a timeline on what means short and long term investing. Now, other terms that are used is active and
Mm,
actively and passively managed
yeah,
funds. Um, could you explain the difference and then maybe back to what you have?
yeah,
Is yours actively or passively managed, and why? Just to also give the listeners an understanding for that.
yeah. Yeah, it's really important to know if you're invested in active or passive
Yeah.
funds. Um, so financial institutions, like they hire fund managers to create funds, to manage funds, and to just kind of handle investors, funds and investing them. And so when a firm creates a fund, like there's fees to manage it, and that person needs to be paid. And so when it comes to an active fund, what's happening is the fund manager is actively picking which stocks want to be part of this fund. So they're deciding like we think that this company is going to do well over the next 5 years. We're going to put a certain portion of it in this fund, or like this company also looks like is projected to, have a high performance over the next 5-10 years. So we're going to add it too. And then they're kind of almost like actively buying and selling within the fund with the whole purpose to outperform the general market.
Mm-hmm.
And what happens though is that the majority of the time, that does not happen over the long term. There may be a period, 5 years, where they outperform significantly, but what they don't show you usually is the long-term performance. And in addition to, because they're doing all this buying and selling, there can be taxes involved and transaction fees. The fees on the fund to actually invest in the fund can be significantly high, like 1% or even more, which over the long term can significantly cut into your investment profits, because if the fund goes up one year, you have to pay the fees. If you lose money that year, like if your money goes down by 10%, you have to pay another 1% of that in fees to the fund manager.
Mm-hmm.
So to me, it's just, it doesn't make sense. Like, yeah, okay, I could invest in this and I could make a higher return, and maybe you will, but are you going to know like when to sell or when to buy? Like there's a whole timing the market's a whole different conversation, but I mean, these are the best of the best trying to time it. And usually they just don't, over the long term, they don't outperform a regular just stock market index fund. And so I guess what I didn't mention about index funds when I was first talking about them is an index fund is built around a predetermined index, which essentially is just a market segment, a number of companies put together based on something.
Mm-hmm.
Like the top 500 companies. So that's the S&P 500, one of the probably the top index fund out there. The Dow Jones, the 30 most prominent companies in the U.S. The NASDAQ 100, which is the top 100 companies on the NASDAQ exchange, mostly tech stocks. So those are basically created based on a certain market or market segment. And so there's no actively buying and selling, picking and choosing. The funds are just already built around that, and what companies make that up is how the fund is created around. And so the fund performs however those stocks perform. So it's really just a passive approach, and because there's not a whole lot of buying and selling, the fees are very low and really don't cut into your investment. So that's really the main difference between active and passive, are the fees involved.
Yeah.
And it's called the expense ratio. So that's something to look for when you are choosing funds, is just to make sure you compare those. And kind of a rule of thumb is under 1%.
Absolutely. That's very well done explained. At least I got it.
Yeah, we're going technical on this episode.
Yes.
So be prepared.
Yes. I'm just going to summarize it. So, and you're going to tell me if that's right or not.
Okay.
I'm going to go very simple. First of all, I just want to quickly say, when I realized that like 90% of the fund manager are actually not outperforming the market, I was like, what the heck? Because it just probably feels better I'll give it to someone who should know what they're doing. But that's, again, giving your power away to someone that can try his best, but is still not gonna outperform. If you know that, then you understand. But because I hear it a lot, that people tell me, I just want to invest. Can I just like give you like the amount, and then someone else manages it for me? Because they're kind of like, when I give away the responsibility of actually getting it. So the whole selling and buying, just to give our listeners an idea, is you buy and sell to a price because you expect a different price. So you go in because you want to go out in a lower or higher pricing.
Yeah.
That's what they're actively doing.
Yeah.
When this is not happening, when it's kind of like set as in the S&P 500, how do I know that when we're not actively taking part in the market, that we're still taking part of the market? So if things are going well in a certain area, how do I know that my portfolio is taking advantage of it if no one actively watches it? What happens there? So if it's like passive or active, first of all, how do I know what it is? Is
Okay.
like, who tells me that? If I have no idea and I just want to like start with it.
Yeah.
How do I know if it's active or passive?
Yeah.
Where do I see that?
Yeah. So anytime you look up a fund, in the fund's prospectus or the details, which are always on like a broker's site. So whichever broker is providing the fund, they will have a page breaking down that fund. So
Yep.
what's in it, what are the fees, and usually they give only like the last 5 or 10 years or 1 year performance of it. So they'll give those details too. But what you want to look for is if it says index fund in the title of the fund. So usually it'll be there, or somewhere it'll be like what this fund tracks. And
Okay.
usually, like if it's an S&P 500 index fund, it'll say tracks the S&P 500 in those details. And then it'll also break down what specific companies and their allocations are part of that fund as well. So it's all in the details. And so when you're choosing a fund, or you find a fund and you're considering purchasing it, look to see if it's active or if it's an index and what it's tracking. Look at its historical performance, and then also look at the expense ratio and make sure that's low, ideally.
So if the expense ratio is quite high, I could get a sense of this is probably not passive.
Yeah, like if it's over 1%, most likely it's active. And I have noticed there are some funds that their fees are lower now that are active. I still tend to just shy away from that because I just rather invest in an index fund and know that it's going to perform just fine, because at the end of the day, like your investments are to get you to a point that secures your financial future, right?
Yes.
It's not about making the absolute most amount of money or making 1% higher in a couple years. Like that's really not going to make a difference. And you're never really going to know of that difference, until like years in the future looking back. So, yeah, that's kind of my approach to it.
Cool. Yeah, I think that was quite a good introduction, because now we covered fees as well. That was the second thing that I wanted to talk about. You also covered the diversification of having an index fund, like this whole bucket of like the salad with lots of ingredients and not only one. Yeah, so I think we're ready to go a little deeper in how index funds work. And there, I would love to hear you explaining how they operate and what are the underlying principles behind their performance. You touched base a little bit on it, of like balancing out which one performs better. So we're going to put some more weight on that one.
Okay.
What other principles do they use in order to make it work for us?
Yeah. Yeah. Well, index funds, so if we're talking about stocks, their performance is really based on the collective performance of the stocks in those funds. And so like Microsoft, for example, is the holds the majority weight at the time of this video, and the S&P 500 is around like 7.25%. I think I looked at it the other day. I don't know why, but yeah, I'm a nerd. I love the numbers. So like Microsoft, there's revenue projections of what they think the company is going to do, and they're always working towards things to improve the company, improve the technology, and grow the business, just like every other major company in the US. And so the great thing about investing in stocks, especially here in the US, is like you're betting on US companies. You're betting on the performance of people, their smart minds, hopefully, and everything that goes into it, right? So the whole, and then you get to invest in all of these companies as a whole.
Yeah.
Through index funds. So it's really, I'd say the driver is really based on company performance. And where we get into, declines in the market is just where things as a whole aren't going well. Like I kind of mentioned before, politics, wars, uncertainty, and fears, and we just like don't know what's going on.
Mm-hmm.
And the actual price declines are driven by a large amount of selling, supply and demand.
Mm-hmm.
And so that's just driven by uncertainty or lower performance projections, things like that. And so that kind of affects, those price movements. Yeah, I mean, index funds, it's driven by the company's performance. And then we have other, an index fund doesn't just have to be stocks. It can be like bonds or commodities or real estate investment trust, which is another type of financial security. Mm-hmm. So there's a lot of like different things that you can invest in depending on your goals, and the return you get is really based on what you actually invest in, right? So there's not just the S&P 500. There's a whole bunch of other types of index funds built around different things like large cap companies. There's index funds built around that. Mid cap companies, index funds built around that. Same with small cap companies. Mm-hmm. There's sector funds. So if you want to just invest in a bunch of energy stocks or technology stocks, you can buy a fund like that. So it's kind of like fun because you can and get to pick and choose, and there's not really necessarily one right thing.
Yeah.
There's just a lot out there that makes it confusing and hard to choose. And once you really understand it, then you kind of have some fun and flexibility over what you want to put your money in.
Yeah. When we talk about, because that question just came across my mind when you said like it's fun because you can choose from. Now, let's say someone opens a broker account and they want to invest in the S&P 500, and they might have like a budget. Now, when it comes to budget, how much do I actually need to start? Because of the fees, which are still there, even like if it's passively, like a passive, like it's still the fees are still there. How is like the weight there of actually gain some dividends or like profits?
Okay, I see what you're saying. Yeah, so basically when you invest, so their funds are structured in two types of ways: mutual funds and ETFs. So you can have an index fund, an S&P 500 index fund. That's a mutual fund version and an ETF version. Vanguard's a big brokerage company. They do that all the time. Mm-hmm. So I'm just going to talk about ETFs because ETFs, it stands for exchange traded fund, by the way. So it trades just like a stock in the market. And essentially, you're supposed to purchase that based on the value of it. So probably, like I know one of the funds is ticker Vanguard's S&P 500 ETF is ticker VOO. And I think theirs is around like $400. So you would have to invest that amount to get started. So you'd invest by the share price. Now, something recent is another brokerage firm called Fidelity allows for fractional share buying. So you can actually like invest, I think as little as like $1 in a fund. So you can invest by the share amount, which is amazing because you can really get started with a little amount of money. And so to actually invest, you need to, either pay the price of that fund or, invest what you can. And then the fees that you pay are actually taken out of that investment. So you don't have to pay the fee, like separately in addition to that. So and if you're only investing like $1,000, like 0.01% fee is, I don't know,
Isn't
not even a
yeah.
dollar, right?
Yeah.
Simple
Out
math
of
here.
yeah.
Simple math. So it is going to be really small. And then how you're paid through index funds. So I think this is something that you were leading into is you're paid through the gain. So the value of the fund increases and also dividends. So dividends are basically like a thank you payment for the companies giving back to you for investing in them because it's a mutual beneficial process.
Yes.
Process. You benefit as an investor from gains, and the company benefits because they have more money to reinvest into the business and grow the business. So it's a
Absolutely.
win-win situation,
Yeah.
which is nice. And those dividends, by actually reinvesting those back into the fund, can go a lot further too in reaching your financial goals.
Nice. Also, very good explained. So, for all the listeners, what you said is literally imagine I'm a business owner. She kind of like lends me money, and I thank her with a little portion of it.
Yeah.
And that's how you get like that that tree growing,
Yep.
um, whilst you grow the whole pot, right?
Yes.
So that's very cool. Would you say it's also important to carefully choose the broker, or does that not play a big factor if you invest in, let's say, the S&P 500
Yeah,
overall?
it so there's a lot of different brokers, and at the end of the day, the whole point of a broker is to get you from point A to point B, is to get you your money invested and growing your wealth pot. So as long as the brokers have the option for you to invest in what you want to invest in, like if
Yeah,
it's index funds, if they give you that option,
yeah,
then that's perfectly fine.
right.
Um, what I'd be careful of is like if you want some flexibility in the types of funds or what funds are offering, that's where you need to explore because like for Vanguard, for example, they're known for their mutual funds. And I think mostly like all of their funds are just Vanguard branded funds. So if you want to buy anything else, there's either going to be like a fee to buy that other company investment, or you're just going to have to do that on another platform.
Yeah.
Fidelity is my favorite brokerage platform, by the way, because they not only allow for fractional share buying, but like they have Fidelity funds, there's individual stocks, there's commodities, REITs, and you can buy Vanguard ETFs and a whole range of other different fund company ETFs on there as well. So
Mm-hmm.
you pretty much aren't limited with that platform. So it really comes down to what do you want to invest in, and does that brokerage firm offer that?
Supports that. Okay. Okay, cool. Um, I think we've covered how funds work. So I'd like to move on a bit on how to actually build a,
Mm,
successful six-figure portfolio now that we kind of covered what it is and how it works. For that, you've successfully built a six-figure investment portfolio. Could you share your strategy,
yeah,
especially how? I mean, you essentially named how it played a big role, but
yeah,
what was your strategy behind? Maybe
yeah,
on like how much did you start, and how many years did it take you to grow that portfolio? Just
yeah,
to give our listeners a bit more of a
yeah,
clear picture.
yeah. So I think my money's probably been invested for um, 7 years now. And what I did was a couple of things. So I would max out. There's a couple of different accounts, and depending on where you're based, that's going to depend. But for me in the US, there was two accounts that I always took advantage of. One was a Roth IRA, which is an account that allows for tax-free growth and withdrawals in the future. And so that amount that you could invest per year, it's gone up. I think it was probably around like 5 or 6 thousand when I first started contributing to it, and since it's gone up to over 7,000 per year. And so I'd max that out every year, And then anytime I had an worked for a company that offered employer 401k, I would invest in that. If there was a Roth version, I'd opt for the Roth version because that's also um, it's similar to the Roth IRA where your money will grow tax free. But what I did was whenever I could, I would, invest as much as I could to it. And then my most recent position, I was making a significant amount of money and invested like half my salary to it. So
Mm.
I didn't max out my Roth IRA, but I came pretty close. And then what I did, because like the 401k is, a, a deferred taxable account. The Roth isn't, but every time I had a 401k, I would roll that money over. So I'd actually move that all into a Roth IRA. So I moved every single
Mm.
investment account I can that I could over into a Roth IRA. So that's allowed me to probably contribute an additional $40,000 into like a Roth IRA through that type of strategy, which is really
Mm.
where the magic happens because
I
I was
see.
like, while we have the ability to do this, I'm taking full advantage of it. And like, there's a lot of like, tax things involved that you need to be aware of. So don't just, go and blindly do that. But I would say that's the biggest thing I did was I took advantage of um, investing as much as I could in those accounts and then rolling them all over early to where it be tax-free growth because I plan to live off of more money than I am now in the future. So
Mm.
that was kind of my strategy in a nutshell. But I think when it comes to investing and really building the wealth and getting to that point, it's really just about investing early and often, consistent through the ups and downs, not worrying about trying to time the market, just starting to invest and doing it on a consistent basis is really where the magic happens there. Yeah.
Yeah. Something that you mention quite often, and the reason is because it's important, is that tax-free
Mm,
investment. Um, could you give us just a quick maybe view on why do you say that is so important?
yeah.
Because
Yeah.
there's a huge difference on having it tax-free
Yeah.
than having to pay tax in the end.
Yeah. Yeah. There is. And take this with a grain of salt because there's a lot of, I guess, situational factors involved in this. But to keep it simple for me is like a lot. So the two taxable accounts are Roth and traditional. Roth is where you pay all taxes on your income now, and in the future, it's all tax free. Growth and withdrawals. You can access it all at once in retirement or little by little, and then you can also pass it down to your kids tax free.
Mm.
So that's huge for generational wealth. The traditional IRA, there comes a point, I think it's at like age 72, if I'm right, where you're actually required to take withdrawals.
Mm-hmm.
And so, depending on how much your money grows, that could be a significant amount of taxes that you're paying. Like, it could put you in a really high tax bracket
Mm-hmm.
where you're paying 40, 50% on your taxes, like if you're in California, for example,
Yeah.
because it's taxed as income, it's taxed at your regular income. And to me, I don't know how much money exactly I'm going to have yet
Yeah.
or how much I want to live off of, but it's going to be much easier to pull out, 40 or 50k in a year and know that I have this full 40 or 50k than pulling it out and then having that like cut by a portion or something.
Absolutely.
So that was like the big thing for me is like I want to make the most out of life. I want to enjoy my life. I want to have nice things. I want to give a lot. And so once I get to that point, I want to be able to really enjoy all of it. And I don't want to pay taxes. I just, who wants to
I
pay
can,
taxes?
I know.
Right?
It's like yeah. And that's also where I believe when you are not taking advantage and learn about money, you are just going to end up pay tax
Yeah.
in a way you're not gonna like it.
Yeah.
And you're gonna feel like, again, the system is the reason why I don't have it,
Yeah.
just because you didn't learn to actually, instead of going against the system, go with the system, but make it smart. And
Exactly.
wealthy people do that
And
every
like
single time.
investing in like a financial coach like you and I is such a small amount of money compared to the amount of mistakes that we can save you
Hmm.
from, basically, and
Absolutely.
money. And
Absolutely.
and by setting it up right from the start, like if I went back 5 years and knew what I knew now,
Mm,
I'd probably have at least over double what I have invested.
yeah.
Easy.
Yeah.
And I want to look back at that and shake my head, but again, you only knew what you know.
It's
So
fine. Yeah. Yeah. I guess if you actually start with 18 but guided, you would be ahead of us.
yeah,
Like,
way, way ahead of us.
because yeah, I mean, yeah, that part of figuring it out, you actually can skip that.
Yeah.
But just
Like anybody in their early 20s who's making a good amount of money, like you have a huge opportunity to just expedite your wealth building journey,
yeah,
retire early,
yeah,
make a huge impact on your future and your family and everything by
absolutely.
starting early. So it's huge. But yeah, anytimes, honestly, what I've learned is like anytime at any stage in life is a good place to be investing still for a
Yeah.
multiple range of reasons.
Yeah. It's like there's never, like, there's a saying, the perfect time to start was yesterday.
Yeah.
So it's just start now.
Yeah. I always say
Don't.
the perfect time to start investing was when you're in the womb, but that's not possible, right? So
Yeah.
the next best time is now.
No. Right. Yeah. Um, okay. I have some more questions,
Okay.
but I would love to go and get some tips on investing in index funds.
Yeah.
Um, and there I have the question for you about, maybe you could tell our listeners who are considering now investing into index funds, what tips or advice would you like offer them to get started. Now, again, disclaimer: whatever we share here is education.
Yeah.
It's not a go and do this, because maybe whatever tip we give is still, your journey is still very personal. So maybe you want to check in before you do something. But in general, what tips would you, or advice would you give listeners who are now thinking like, this sounds very interesting, I would like to get
Yeah.
started?
Well, great place to find more information on funds are on brokerage websites.
Okay, cool.
So whether that's Vanguard, Fidelity, Charles Schwab, they have they have pages of information on funds. So you could start there, explore what like ETFs or mutual funds that they have, understand more how they work, and just kind of like start to poke around and see what's actually in the fund.
Hmm.
And then try to figure out like, how has this fund performed over time, like during different, like if you're worried about risk, look how it's performed when there were bad times in the market, like the 2008 housing market crash or during COVID. Just like see how it's performed and kind of then start deciding like, is this something that could make sense for me, or is there something a little bit more safer that could make sense? So just, I think really just starting to educate yourself.
Cool.
It all starts with that education piece.
Nice. I'm
Yeah.
gonna link some brokers below this episode. So if you wanna dive into it, just you find some links below. Um, when it comes to the amount, would you say starting off with like maybe 100, put them in and let them grow, or would you say continuously um, pay towards this account?
Mm.
What would be like more of a strategy?
Yeah, I like so I think you're referring to like lump sum versus like dollar cost average.
Yeah.
Yeah, so the debate is that when you invest all at once now, like usually the market always goes up like 3 out of 4 times the market's going to go up in a year. And so it's like if you invest now, your money's going to go further. But like if you invested break before a crash, that would not be fun. So
Yeah.
dollar cost averaging, investing a portion of your paycheck every month is a really good strategy to capitalize on um, low prices, maybe some higher prices, but over time, it's not going to matter.
Yeah.
And I think that makes sense for more people because I think more people are, working a job and having income on a monthly basis. So getting that habit of putting a portion away is a really good strategy to take. And that's what I do.
Yeah. Yeah. I like that approach, just because when you try to time the market, you're you're probably gonna end up missing it because it's just very
Yeah.
hard. Like,
You
just
never know. There's
you
too many
never
factors.
know.
Yeah.
Yeah, yeah. There's so much that plays in role of that. So we have that also. Um, and what is a common misconception when it comes to index funds? What do we hear? Maybe if you talk with your clients, what is something that you hear often, if there is something, or what is a misconception about index funds?
Hmm. Okay. I think something that I see at least online a lot is like if you invest in the stock market, you're going to get a 10% return on average each year. And I think
Uh-huh.
understanding what that actually means is
Yeah.
that on average over the long term, it can equate to 10% per year. But there can be years where it's gone up 40%, right? Right after crashes, or there's years where it has gone down 50% from the last year's high. So it's understanding that like you don't invest in a fund and then every year you're going to get X amount of money. It's going to grow as it grows through the ups and downs, and kind of being okay with that long term potential. And that it really, it's not guaranteed, but historically is how
True.
we kind of look at the stock and look at the data and use that to help project what's going to happen in the future is helpful. And seeing something that does have a long-term positive history is a good place to start. So just really
Yes.
understanding how they grow is important.
Yeah, that was very important to touch base on the 10%. Um, because yes, when I'm just going back into a time where, like, even on, I mean, you have Roth IRA here. We do have similar systems in other countries, especially in Europe and Switzerland. It's not the same, but it's similar. But what people see is they see 10% or 8%,
Mm,
and then they start to calculate. Like, I'll put in $100 or euros, Swiss francs, whatever. Then they multiply by 12 every month, and then by the year, and then they tell, like, and then they go buy the 10% and they hold on to that 10%, which, but you said, well, like, it can
mm.
go up
Yeah, or they're like, why isn't my money
massively.
growing? Well,
Right. Yeah.
because it takes time.
Because that's not 10% that you can calculate with. That's just like on average, and
Yeah,
average means in like
yeah,
a timeline. It has
exactly.
been proven. Yeah. So that's very important. Um, yeah. When it comes to historically proven, what would you say is like an amount of years historically
Mm,
proven that you would say, um, yes, we can kind of like trust that
yeah,
number, because obviously, like, it's not going to be bad if it's like maybe it's just been like for 20 years, but then some others have been
yeah,
around for like more. So what
yeah,
do you know, like a number, or how would you say that is historically proven? I trust that,
yeah,
or that sounds too new to me. I'm not going to
yeah,
go with it.
yeah, 40 years.
40 years. Cool.
Yeah, I usually use like an 8% projection just because I think that can be a little bit more reasonable, especially if you have a shorter time horizon. Like if you purchase, during a crash, like you're going to do a lot better um, if you do get something timed right. But yeah, over the long term, you are thinking like 10%, I would say like 40 years. And But like, that's why if you project something a little bit lower than that, like 8%,
Yeah.
and it does better, then you're going to be a lot happier than having that expectation that I'm going to get 10% and then it maybe not exactly doing that and then just thinking it doesn't work. So.
Love it. Good. Yeah, I like that we get very clear on this. I think if you are writing down or whatever, how you indulge all of this information, we get very clear here. One last question. Can you describe in your own words, what is passive income for you?
Yeah, passive income is when your investments are making you enough money every year, either through growth or dividends, to pay for all your expenses and some.
Good. And would
Yeah.
you agree, to get to the passive income, you have to actively do something for it?
Absolutely.
Good.
Yep, absolutely. You got to put in that work.
Glad. Yeah, I'm very glad, because I guess people expect passive income to grow, but there's always an active movement before it gets
Yeah.
passive.
Yeah.
So,
well, with investing, with how we're doing it, it can actually be pretty automated and simple,
right.
which is a whole reason to get started this way.
Yes.
But yes, there is that active piece, absolutely, that you actually have to learn and figure it out and then do it.
Okay.
So
cool.
yeah.
To finish up this conversation, could you give us or our listeners an advice that you would give your clients or anybody that would come up and ask for help, wants to start with investment? What's an advice you would give them if they want to start with it?
Yeah. What I would suggest would, just to get started, like, start researching, start learning. Like I said, index funds, the reason I love them is because they are a proven type of investment with a historical um, long-term performance. They're easy to get started with. You don't need a whole lot of money, and they're truly passive and they're liquid. So if you ever do need your money out, assuming it's not, in a certain type of account, like, you can access it. So I think, like, just start learning about that is the best thing that you can start doing, and knowing that that is a proven type of investment is great, versus trying to explore all these other things and trying to figure out, like, the one that's going to make you rich overnight. Find something that really works, and just, even if you start putting just a little bit of money towards it, just to, like, see and build the confidence and feel comfortable. But time is your friend when it comes to investing, because of compound interest. So it's definitely something to get started with and really make that a priority.
Yes.
Yeah.
Yes. I just love this conversation. I could go on.
We did a lot. We dove deep.
But I would say, yeah, there's a whole lot of value in this conversation about index funds. And I want to say thank you. I really appreciate you for sharing all of that, because I don't think that it would be so easy and so accessible. But you explained that very well, and I'm very glad to have you on the show with us. I'm going to link all your information. So if anybody wants to connect with Nicole directly, I guess if they have questions, they're allowed to text you.
Yeah, reach out. Love that.
Yeah, just don't be shy. If there's never a dumb question. If you feel like you wanna just have a conversation with her, go ahead. And once again, thank you so much for being on the show.
Thanks for having me.
Have a good one.
Yep, me too.
Thank you. And that wraps up another empowering episode of Inspire Greatness. I hope you found inspiration, insights, and a renewed sense of purpose during our time together. Remember, growth is a journey and not a destination. If you enjoyed today's conversation or have thoughts to share, connect with us on social media or within the community area. Your feedback means the world to us, and I love hearing from each and every one of you. We have a lineup of exciting topics and incredible guests coming your way, and I can't wait to share these transformative moments with you. Before I log out, always remember, you are capable of incredible things, and your journey is uniquely yours. Cherish the moments of growth, and embrace the beautiful unfolding of your own story. Until next time, this is Demi, signing off from Inspired Greatness. Take care and stay inspired, and keep on growing. I'll catch you in the next episode.